While you're reading this disclaimer, don't forget to subscribe, tap that like button, and remember to feed your pets healthy food, not just snacks, all right? Hey, trading kings and queens, welcome to Unit 3, Video 1 of the Futures Basics course here from King Capital Trading. I'm Adam King. We're going to be going over understanding points and ticks in futures in this video. Again, this is not any professional or financial advice. This is meant to be for educational purposes only. And as usual, click the link in the description to access all these videos in our free members area. It's not just the videos that are posted here on YouTube. You get access to all the other resources, slides, checklists, anything else that I give away for free, as well as notifications of when I go live for free, where you can look over my shoulder and see my trade. So that being said, jumping right in here, a tick is the smallest possible price change for a futures contract. You see, you're not trading in cents. You're not even trading in like percent or per dollar. It is a tick. It is a movement, and depends upon obviously the actual instrument that you're trading, whether it's the S&P 500, which we'll do a quick example here in a second. Could be gold futures, could be any number of things. A tick is just a representation of a unit. So again, it's not a whole dollar. It could be a quarter, like it is here for the S&P 500. So a tick, again, is the smallest possible price change for a futures contract. And then points is a larger increment that can, again, vary by contract. Again, so I want to go over a specific sample here. If you look at the image to the left, this is the S&P futures. When it moves in 0.25 point increments. So 0.25 point increments. Each one of those points is a tick. So if you hopefully can see my mouse here, it's got 5771.50.75 is 0.25 of an increment, right? That is one tick. So each contract, let's say, I get a contract for $12.50. It moves up one tick, and on a buy contract, when I'm going long on a contract, I've made now $12.50 per tick, right? Now, well, how many ticks am I risking, right? How many, what's going to be the risk per trade? What's the potential reward per trade? Again, that's coming. They're going to be talking about, we've been talking about all these concepts and all the courses and videos I've got. But ultimately, in this case, 4 ticks is equal to 1 point, which would be $50. So each point on the S&P 500 in this example is $50 worth, right? So if I want to risk $100, I'd be risking 2 points on the S&P 500 because I'm risking $100. If it goes down that whole point, I'm out. I hit my stop loss more than likely, and I'm out of that trade. If it goes up a whole point, I'm now making that $100. Or again, depends upon. Now I feel like I'm already confusing you. We're gonna go over this as a specific example. How about we do that, right? So I'm gonna go over another quick example with gold, but I'm gonna just show you this how it actually works in Tradingview in a second. So just bear with me. So in the case of gold futures contracts, it may have a tick size of $10, while oil, copper, platinum, etc. It's gonna have different values. So knowing these values is a key to calculating the profits and losses and the potential risk and reward that you have. At the same time, luckily, the trading software I use, Tradingview, does the calculations for me. So again, like it's nice to know that a minimum contract is a certain dollar amount, because if you're only looking to risk $50, but the futures contracts are worth more than that, well, in order to get even one contract, you'd have to risk more than that, right? So the way I relate that is like I can't walk into a bank and say, hey, can you make change on this $50 bill? And they say, okay, sure. What denominations would you like your change in? And I say hundreds. They're going to look at me like I'm trying to rob the place, right? I'm not trying to rob the bank. I'm trying to get, break a 50, right? Like, no, in order to break a 50, you have to have, hopefully 20s, 10s, 5s, whatever it might be, right? However you want to, whatever denominations you like it broken up into, right? It's the same thing here. So if you want to risk $100 per trade, you might be, again, depending upon the trade in E-mini or a micro type of contract, and that's going to depend upon it all varies upon the units. And again, this might sound complicated. It sounds complicated. It sounds like I'm reading from a boring freaking textbook from college right now, but really, let me just show you how this works so you can just see how simple it actually is. Okay, cool. Here we are on the Nasdaq. I am signed into my Tradingview account as well. I'm going to open up the order panel right here, and you can see I can put it in order. I can do a sell or I can do a buy. Let's just look at this and say, okay, I want to risk, on this is the E-mini, not the micro. Micro is this one, I believe. Yeah, there we go. So you can see here, even just me switching between these two, you can see I'm risking 4 units here, but one contract for me at stop loss of 50 ticks, $5 per is per contract for 50 ticks is $250. If I go into the micros and I risk a stop loss of 50 with one contract, that's only $25. You see the difference is a tenth. It's 1/10 when I switch between the E-mini and the micro E-mini, right? So again, it's the same exact Nasdaq 100 right here. So it's both Nasdaq 100. You can see I switch between the two. The prices ain't moving. It's how much am I willing to bet? How much am I risking per contract? Cool. So now in the case of my personal risk reward ratios and everything, I want to risk 4 units, so I'm risking about $1,000 for me. This is about 2% of my overall account, 2.08% of the account. So the account's at about 48 grand right now. So I'm risking a little bit more than 2%. I like to risk typically 1 to 2%. Again, a little more experience in this, so I don't mind being over 0.08 of a percent. But if I only wanted to risk half of that, 1%, I'd bring this down to 2 units, right? Now, what does this actually look like on the graph? Long position right here. Ticks is 50 in this case. I am on a 4-hour. I would not want to do that on the 4-hour time frame. So I just double clicked the prices over here on the left hand side, by the way. And that is going to just kind of reset the drawing. So anyway, so this is a 50-point stop loss right here. So I've just kind of drug. This is my long. I'm looking for a buy. So this is a long. From the bottom of this red box to the entry, which is the top of the red box, the beginning of the green box, that's 50 points. I have my take profit right now set to 150. So I can kind of click and drag this up to the 150. And this is what I'd be looking for. So if I was looking at a trade here and I used the bit method and I got in to a trade after I had seen the green diamond here, that's my king of diamonds, and I got a solid close above the line, I would get in here. And again, lots of ups and downs, but you can see as soon as the price tapped the top of my green box here, I would have been out of this trade. Again, risking $500, this would have been a $1,500 win for me, which is pretty sweet. Right, so $1,500 profit. Contrary against sell would obviously be in the opposite direction. So the cool thing about this is no matter what I change, if I want to now change my stop loss, and by the way, you can double click these and just manually change it here to 100 and hit OK. You can see now it changed this. I can change that over here too, but if I change the size of my stop loss, you see how that changed the amount of risk I have? Well, dang. Well, now if I have a bigger stop loss, I got to go down to 1 unit. So now if you're looking to trade on the E-mini Nasdaq futures and you want to trade less than $500, I can't go less than 1 unit here, right? So if I have a stop loss who's 100 ticks and I have to risk that $500, it's $50. I'm sorry, $5 a tick. And that's it. That's all I got. That's all I got to deal with. That's it, right? Well, I can still trade the Nasdaq, but instead, what I do is I'd go over here to the micro E-mini. I'd still look at my 100 tick stop loss, right? In this case, again, I was at 50. My bad, 50. Right, let me go back just to double check what the heck I'm doing is accurate here. Yeah, that was the original. That was the 100. So I'm gonna go back to my 50, like I had it here before, right, like that. But now I go here and I do 50. I'm doing it in the wrong area. That's why. Duh. There. So you should see it should still be roughly the same amount of ticks here. This looks like this tail, this little wick went down further on the mini. I'm sorry, on the micro rather than just the E-mini. That being said, now if I want to risk less than that $500, what do? I would have gotten to a buy. I would have said, okay, my stop loss is still a 50 tick stop loss right here. In this case, one contract is only $25. So maybe I'll do 10 contracts, right? Still have the same take profit, still the same risk reward ratio here, right? And now I'm ready. I would have been ready to place that trade. Now, the amount of time that I had to set that up, you need to have this ready and anticipate that you're getting in a trade, because if that took you longer than 30 seconds, you missed that entry. Could get in it again, obviously, but long story short, that was a perfect entry right there. So anyway, so that's pretty much it for that, guys. We're going to continue on in the next video. And remember, like, subscribe, share these videos, watch this entire playlist. Hope you get a lot out of this, and we'll catch you guys in the next one.